We always hear about creating a financial plan for your future. But what about creating a plan for your present to create that freedom right now? Let's talk about that today. Hello, my fellow Ripplers. This is Chris Miles, your cash flow expert and anti-financial advisor. This show is for you. You work so freaking hard for that money, and you're now ready for that money to start working harder for you today. You want that freedom, that cash flow now, not 30 or 40 years from now, but you want it today to where you become work optional. You work because you want to, not because you have to. Why? Because you have enough passive income coming in to cover all of your needs and then some. And that is something you want to do because you don't just want to get rich, although you want that financial freedom, that time freedom, and everything you want in your life, especially while your family's still there. But you want to have that time with your loved ones. You want to be able to time to do the things that you love. So you do what you love with those you love right now. And it's not just about getting financially rich now, it's about also being able to create a ripple effect through the lives of others. Because as you are blessed and prospering financially yourself, you now have a greater capacity and ability to bless the lives of those around you. That is the purpose of this show today. Thank you for tuning in to this Money Ripples podcast. Thank you for binging and sharing our episodes and allowing me to create that ripple effect through you. And most importantly, guys, I also want to thank you for being such a faithful listener. I know that you guys, the audience here just keeps growing and growing and growing, and that's all because of you. And this ripple effect I'm trying to create 1,000 financially independent families before 2030, that's possible because of you. So thank you so much for doing so. Hey, if you haven't done so already, if you're also following us here on YouTube, you can also follow us on social media at Money Ripples, whether you're on Instagram, TikTok, X, Facebook, LinkedIn, whatever. Be sure to follow us so you can stay in tune when new updates happen. All right, so let's talk about this because I remember as a financial advisor, 20 plus years ago, I was telling people, hey, you just put your money away forever. And guess what? Someday you'll have this great big nest egg that you can live on, right? And we always talk about that future plan and what happens in 30 or 40 years from now. But like I just said in the intro of this show, what about today? Everybody talks about future planning, but what about present planning? How do you plan for the present? How do you actually create real cash flow now versus waiting 30 or 40 years to see if it even works? That's what I want to discuss with you right now. All right. Now, if you've ever met with a financial planner, and I imagine many of you guys have met with some kind of planner or advisor at some point, if you haven't, lucky you. But for those of you that have, that's also a good thing too, because you get to see the contrast. Because when I started out, I would show somebody kind of a calculation like this, right? Maybe let's just say you were starting out from scratch. Maybe you're this bright-eyed, bushy-tailed person that's starting out in your 20s. And I'd say, listen, if you just put $10,000 away every year, right? Or, you can do it monthly, of course, but put away for every year. Let's say, hey, if you put it in and you earn 12% a year for the next 40 years, right? By the time you get in your 60s, you're going to have $8.5 million. Can you imagine being a multi-millionaire? That would be awesome, right? Now, there's a few problems with this when you're talking about this future planning. First and foremost, you got to, and I talk about this all the time on the show, the assumptions and the numbers. The thing that got me quitting as a financial advisor is because I realized I was overpromising while every financial advisor was under-delivering, right? We were all overpromising and under-delivering. Why? Not because we all suck as financial advisors, but because we were all really in bondage to the same stock market, right? So first and foremost, if somebody says, oh, I'm going to be more conservative, I'll do 10% instead. Well, watch what 2% does to your number. Boom, you just cut it in half. It wasn't just a small percentage that cut. You literally went from 8.5 million down to 4.8 million. Nearly half it got cut down by, right? But guys, you know this, if you've watched this show enough, or if you've seen my different webinars, the market has only averaged 8.74% in the last 30 years. And that's one of the highest numbers I've ever seen. Usually it's between 7 and 8%. So let's just say you happen to get 8%. And yes, that's even those of you that get matches with your 401ks. If you watch other episodes about the lies, the 401k lies and myths that are out there, you'll also notice that the numbers that you get, usually the match only makes up for the bad performance of the funds. So let's just say you get 8%. Now all of a sudden, look, I went from initially 8.5%. Now I'm down to like 2.8 million, right? So I've now really cut this down by 2/3, even though the interest rate's only about 1/3 less. They always talk about the miracle compounding interest. Well, there's also the not miracle of compounding interest when it doesn't get the number you want, right? Compounding interest is amazing, but what if you don't get that number? Now, 8%, I think it's doable potentially long term. It's possible. I'm not saying it's you're going to get it, but it is definitely more likely than you would doing something else. But remember too, there's also inflation. Remember, I kept that at 3%, and I didn't even focus on inflation. I said, look, still 10,000 a year to have almost 3 million. That's amazing. And I would even say this too. I'd say, listen, like that means if you got 2.8 million, you live on 3% a year. That means you're going to live on roughly about $84,000 a year. That sounds pretty good. That's $7,000 a month. Not a bad lifestyle, right? You save 10,000 to live on 7,000 a month. 10,000 a year to live on 7,000 a month, not 10,000 a month to live on 7,000 a month. That would be horrible. So it sounds great. But remember, we haven't factored in inflation. And I have this 3% in here, but remember that shadowstats.com, you go to their website, they'll say that inflation is about 7% higher than what the Feds say. So the Feds are saying, hey, it's around 2.5% right now. You're closer, probably like 9%. Even if I were being gentle and nice to you right now, giving you a decent return on the stock market, but also a lower than probably reality inflation rate because the Feds have messed with it over the years. Let's just say we put it at 5%. So still, this number stays the same, the 2.797 million. But look at my after inflation buying power. It's just under 400,000 a year, or it's not 400,000 a year, $400,000 period, right? That's the buying power of what 2.797 million will be in 40 years if you have 5% inflation. That's like saying you have $400,000. Do the math. If again, you can live on 3% a year, not 4%. We already know that's debunked a long time ago. 3% a year, 3% of 400,000 means you're living on $12,000 a year. Notice that's just almost the same amount as what you earned or what you put away was 10,000 a year. You can live on 12,000 a year after inflation. Now, I could be gentle on you. I can even make this lower. And this is even way, way more conservative than it should be. If I put it at 4% inflation, notice the big difference. It went from about 400,000 to almost 600,000. But still, you're living on about 17,000 a year. And if you're stuffing your money in 401ks and IRAs, you got taxes coming out. Now you're really living on, again, maybe $1,000 a month or so. Does that sound like the kind of life you want? Even if you max fund it into your 401k, let's say you put in about 20,000 a year, guess what? It's still the same. It's just double the number. So all you did is going from maybe about 17,000 a year now to about 34,000 a year. Woohoo. All right. Good job, guys. That's not anything to get excited about. That's like poverty line even today, isn't it? So this is what got me to leave as a financial advisor because I realized for anybody starting out, this is tough. You got to have like a lot of cash, put away a lot of cash to then live on roughly the same amount for a lot less years. You save up, I call it save and slave, right? You're slaving away at your job for 40 years. You save up everything you can to only then try to not run out of money in about 20 years or so in retirement. Think about that. That's not very impressive, is it? This is what's happening right now. This is why so few people feel confident going into retirement. This is why so many people will continue to keep voting for Social Security because that extra, average, $1,600 a month you get from Social Security, that's about 20 grand a year, adds to this 34,000 a year after inflation. And you think, okay, 54,000 a year is not horrible. As long as I have a paid off house and everything else, I can live on cheap enough. This is why you're always taught to pay off all your debt, stuff your money in these mutual funds that are, of course, gambling away. Shouldn't there be a better answer to this? Shouldn't there be something that gives you a better odds of success than someone who has to be just raking in dough and saving every penny possible so that you can finally have a middle-class lifestyle? Shouldn't there be a better way? The answer is yes, there is, okay? Definitely a better way. Now, this is why I talk about present planning versus the future planning. This has always been future. Notice every financial advisor is always like, put your money away, set it and forget it. You're in it for the long haul. Just let it sit there. This is why my own father, who was a good, disciplined saver, debt-free, just like a guy like Dave Ramsey would tell you to do, he did it to the T. And yet I had to tell him in his 60s, Dad, you would have to die in 5 or 6 years because you'd run out of money. You need Social Security. You need that to even maybe let you go 10 years. Well, guess what? He worked into his 70s before he was forced in retirement due to health reasons. And now he's living into his 80s and he's trying to stretch every dollar he can. He's worried. He's like, Chris, I don't know how I'm going to make it. Like, I'm going to need help from you to be able to make this at this point. Again, disciplined saver did it all right. He was stuffing that money just like he thought. But again, the stock market wasn't friendly to him. Now, the market did recover and that's helped him make that money last now. But what would happen if the market went back down to where it's supposed to be? Look at this. So they call this right here the Buffett Indicator. This is through the end of 2024. And what they're doing, they're taking the gross domestic product, right? The health of the economy compared to the value of stocks. Because what's been happening lately is that people have said, who cares about the value of stocks, right? Like we'll invest in, even the company won't make their money back forever. Now think about this. If you're investing in a company, do you want it to take you 50 or 100 years to make your money back? Of course not. But there are literally companies in the stock market just like that, where it might take you 100 plus years to make your money back to get that value. Things are overvalued right now, and people just haven't cared because there's so much speculation. People are even throwing debt in the market, and that is a dangerous thing. And so, what we're seeing right now is that now the market is well over 200% above what it should be. So, that's 211%. Now, that's 211%. That's Guys, that's more than double. What it's really saying is that if we were to come back to the actual trend of where the value is, and just so you know, a lot of the gross domestic product was government spending, which now they're trying to limit drastically with this whole Doge thing, right? So because Doge is out there trying to cut costs and do everything else, whether they're laying off people or cutting costs of just bad spending, frivolous spending by our government, what that does now is actually it makes our value of stocks. If the stock market doesn't go down, that means the value of the stocks, this thing goes shooting up past 250% because over 25% of that spending was all government. If it weren't for government spending, guys, our economy would not have been growing in the last few years. It's all been government spending driving it up. That's the smoke and mirrors, right? That's what we're dealing with right now. And so if the market were to come back down, this means that the S&P, instead of being about 6,000, it would have to come tanking down to around below 2,500. This means you could be losing 2/3 of your money in the market. If you're trying to retire soon, should be even scarier for you. If you're trying to retire in the next 10 to 20 years, this should frighten you. If you've got 40 years, you might be okay. They might be able to bounce back and the averages might work itself out again. But because the last 16 years have been so just, again, bull market. One down year in 2022, and that hardly did anything. And then we just skyrocketed right back up past it. We are way overvalued right now. So this is the thing that we're dealing with today. Now, you might be saying like, okay, Chris, I got it. Future planning, it's hard to do. I get it, Chris. Like, yeah, the stock market, I could be gambling. But again, what if you could be investing your money outside of the market? You don't have to gamble in the stock market. You don't have to hope and pray. Again, like my dad did, where Y2K kicked his butt right when he was in his mid to late 50s. And then the Great Recession started affecting him when he was already into his early 60s, right? And so that just postponed him into his 70s before he could retire. This could happen to you if you're in your 50s right now. You should be worried. Even if you're my age, I'm 47. You should be worried right now. This could affect everything if you're solely in the stock market. And this is where I come back to is that, again, that's always future planning. They always try to give you averages, but those averages may or may not be true. They might be lying to you, even though they don't know it. They're just giving you average returns. But what if we could do it better? This is where I talk about present planning, because this is what you do. And this is what we do with all of our, I'm just going to pull back the curtains and let you know what we do with our one-on-one VIP clients, right? Those that are paying clients, they do have to qualify to begin. This is why we use the passive income calculator on moneyripples.com. You're welcome to check that out. But we use that calculator to actually qualify our clients to make sure they can make more money than what they pay us in just the first year alone, right? And so that's the kind of our kind of a satisfaction guarantee is that they're going to make their money back in cash flow savings, whether that's from savings of debts, or it could be tax savings and or passive income that they're earning with their investments. Usually we just calculate off passive income alone. We don't even factor in the other stuff, but that's also great too. And so I'm going to use an actual client example, someone who actually hired us going on almost 7 years now. This is back in mid of 2018. This guy came to me. He had about $900,000 in assets, right? $900,000 he had in between actual money we could use, right? They had about 100,000 in 401k that you couldn't touch because it's locked up in your company. One thing I don't like. But this guy, he started looking at other options. He started to see that there was something else he'd be doing. He realized, like many of our people have been asking us, they're like, can you actually do a what quote unquote self-directed IRA? Can you roll 401k or IRAs into this self-directed IRA? My answer is simply this. Go Google it and you'll find a resounding yes. It's very simple. It happens all the time. I learned this even when I was a stock trader, that you can actually roll your money into a self-directed IRA with certain type of companies like Equity Trust and people like that, where you can roll your money over to self-directed. And this means you get to choose where it's invested rather than relying on like Merrill Lynch or Fidelity or Goldman Sachs or whomever you got your money with and have to pick from the little tiny suites of funds that they give you. Okay, so he realized, of course, that self-directed IRA money he's got there. He had some money in other IRAs and whatnot, mutual funds and stocks and bonds and everything. So he had about 900,000 he could work with. His goal was to earn roughly about 6,500 a month. He told me 6,000. I went back through his numbers. Really, he needed about 6,500 a month to be what's called financially independent, where you have enough passive income coming in to pay for your monthly expenses. His monthly expenses, when you took out the money he was saving for retirement, right? Also, we were about to pay off credit cards anyway. So he had some credit card bills. Once those all got paid off and everything, and you factor out taxes and whatnot and savings that he was putting away, he only needed about 6,500 a month to be able to be financially independent, to retire, right? And now he was in his 40s at this time. Now he's in his 50s, but at this time he was in his 40s. And so he was looking for those answers. So a great start. I mean, 900,000 is pretty amazing. Most people do not have 900,000. And by the way, most of our clients don't even have $900,000 to invest right away. And so most of our clients usually have to have at least $150,000, $200,000 to start doing something with us. So we started looking at options. A lot of times looking at rental properties was a big thing we're looking at. Looked at a few other things like different types of syndications, whether it's like in apartment buildings, whether it's in things like lending and whatnot. Looking at all these different things. Now, here's the big thing. Remember, I was looking at cash flow. So one, we were trying to figure out, let's find a way to pay off these credit cards faster. Instead of just using the money to invest, maybe some of these credit cards should be paid off. So we started doing that to free up cash flow. Why? Because instead of him needing like $7,500 a month to live on, freeing up $1,000 a month by paying off some of these credit cards, even a 401k loan or whatnot, that brings down that monthly expense that's coming out, and we free that up. Now we only have to hit $6,500 a month. And just so you know, a lot of times paying off certain debts give you a better rate of return than anything in real estate will do. So we'll start looking at that. Now, in his case, he was a W-2 employee. So tax savings wise, there wasn't a whole lot to do there. I will tell you this, if you're a business owner, oh man, this is like a freaking no-brainer, because as business owners, you've got so many things you can do that I guarantee you're already overpaying on taxes. I mean, it's so common that we'll see people overpay at least $5,000 a year on taxes on what they're doing. So usually we'll find money there too. In his case, he was a W-2 employee. There wasn't as much to free up on the tax side. But unlike some of our other clients, that's where they make most of their money back, is tax savings and maybe creative ways to pay down their debts or things like that, or even just tracking your money, right? Even doing things like that. Now he was doing a great job tracking his money, so he didn't need that as much. But we want to make sure we start to find ways to create cash flow savings, right? Like we say in our guarantee. But then also, now we go to the other side, which is how to invest. And I mentioned he was doing things with different properties, investing in different syndications where you can do bigger deals, have a percentage ownership in things like an apartment building, but you have to buy it all yourself. You have other people that kind of crowdfund and put their money in that deal, right? And as well as different types of lending and whatnot. And so when all was said and done, this guy started to cash flow some more. Now, I'll tell you this, simple math, right? Even before we got to the investments, it was like, okay, you want $6,500 a month. You have 900 grand to invest with. Now, granted, some of that 900 grand were in IRAs and things like that would penalize him for taking out his money before 59 and a half. He was in his 40s, right? It was too early. This is why I said, no more paying into that. So instead, he was starting to pay into infinite banking, into doing a policy that way to start storing money there instead of throwing it to retirement accounts, because he knows not only is it a good place to store liquid cash for emergencies and make a higher return than the bank will pay you, and it's tax-free, but he also has the ability to invest with that money too. If you've been following this podcast, you're probably looking for great ways to create passive income right now, right? Well, we got you covered here with Central Lending. Central Lending specializes in alternative investments that actually are designed to create steady returns and long-term financial security for you and your family. Now, they prioritize transparency. They love, building those strong relationships, giving you that confidence and peace of mind, knowing that you have your money working harder for you, so you don't have to work so hard for that money. You want to learn more how to do that? Go to centrallending.com and check out what they've got today to create your passive income and wealth creation right now. So long story short, I'm looking at the numbers. I said, even if we just do simple math, your 900 grand could be generating, if you only earn 10% a year on your money, 90,000 a year. Now do the math, guys. 90,000 a year. What does that make you? Average 7,500 a month. Again, he only needed 6,500 a month, right? 7,500 a month. Now you might say, yeah, but Chris, remember you said if you have to pull that out, you'd have taxes and penalties. I said, you're right. That's absolutely true. And so we were going to go well beyond that, right? We want to go beyond it and keep reinvesting. And the truth is, it didn't take long. Within a couple of years, he was already work optional, right? He was already at the point he didn't need the money anymore. This is despite the fact that inflation kept rising. Remember, everybody keeps planning for this future, but what happens in the here and now? And all of a sudden, we have this massive inflation surge, and then you feel like you're falling behind. You need more than ever cash flow today. This is the one thing financial advisors avoid doing. How many times have you had your financial advisor say, "Hey, let me help you figure out like where can you find and free up money in your situation right now?" Not just, "Hey, how do you live on rice and beans and get cheap?" Right? But how do we actually find and free up money? How do we actually find ways to maybe pay down certain debts while not paying off debts? What if we refinance a mortgage that actually will lower your payment versus increase your payment? What if we were to do things to actually, again, save taxes? What if we do things to actually reduce your costs on insurance? By the way, I just had a woman that 62 years old, we're lowering the cost of her term insurance. We don't not doing whole life yet because she's paycheck to paycheck, but again, freeing up about $60 a month. Like I almost cut it in half of what she was paying. And so that was a big deal for her. Like, yeah, $60 a month, it won't make you rich, but that's $700 a year, right? And so just little things like that, freeing up that cash right now. And then talking about how do we create passive income right now? Not, hey, in 30 or 40 years, if the sun and the moon and all the planets align, you'll be able to retire at 54,000 a year. Right? No, like, no, you could do it right now. And you don't have to worry about inflation as much because guess why? You have income right now. You're already keeping up with the present day. This is the problem I have with future planning. Notice that 100% of your money is always going into things like 401ks and IRAs. 100%. It's like a negative 100% return. Now, someone will disagree with me. They'll say, "No, Chris, that's going into an account." Yeah, it's going to an account with a bunch of zeros and ones. It's going to a computer screen. Think about this. This money is out of your life. Does your family benefit right now with you throwing your money into IRAs and 401ks? Zero benefit. Now you might say, "Well, I save on taxes." No, you deferred your taxes to a later date when you're likely to pay more money because guess what? Not just because of inflation, you're going to have to spend more money. So even if tax rates don't go up, you're going to have to spend more money and be in a higher tax bracket potentially. But two, all those write-offs you're getting with having your kids at home, having that mortgage interest and everything else that you're writing off right now. Not to mention you might be in a lower income bracket now than in the future because the Trump tax plan is cheaper, is one of the cheapest plans we've had in the last 110 years. And then you still think somehow you're going to save money on taxes. Ridiculous, right? It just doesn't make logical sense at all. And so you're pushing off to the future dates. You're like, well, yeah, what benefit am I giving my family? Because yeah, maybe there's that little tax deduction or income deduction, so to speak. But that's an income deduction because literally none of that money's coming back to my family. And it's not 100% tax write-off, is it? And when I say that, I mean, it's not like 100%, income or tax deduction, like off your tax bill. It's only whatever percentage it is. So if you're in a 24% tax bracket, whatever you save, say you saved 10,000 a year, into that 401k, well, guess what? You only get to write, you're only reducing your income or that overall tax bill by that $2,400, that 24% tax bracket. Not all 10,000 you put away. So 10,000 went out, maybe 2,400 came back. That still means 7,600 net is gone. And then you still have to pay that 2,400 or more later on anyways, right? So your family doesn't get that benefit. Think about that. But if you actually create passive income now, does your family benefit? Does your spouse actually feel a little bit more on board saying, "Hey, I like the fact that we actually have money coming into our accounts versus always going out of our accounts"? Think about that. So let me go back to this guy's situation now. Again, I'm not going to say his name. We keep our clients confidential. I know sometimes we have people say, "Hey, can we talk to some of your clients?" I'm like, well, only if they let you, but we keep everything confidential for that reason. That's why when we ask for volunteers to come on our podcast, the ones that are brave enough to do it, they'll come on and tell you about this stuff, right? Just so that you can kind of quote unquote talk to our clients because they want to tell you what's actually going on. Vast majority of our clients are actually kind of bashful. And so they are like, "Oh, maybe I don't want to come on until after I break 10 or 20,000 a month passive income." I'm like, man, once you pass 1,000 a month passive income, you're already better than almost every one of our listeners already at that point. But again, it's always frame of reference, right? So again, this guy, I just follow up with him last month and I said, "Hey, well, tell me what's going on. Where are you at right now?" He's like, "Hey, I've got some extra cash coming in from the passive income we've been creating over these years." He's already been reinvesting some of it, but he's like, "Now I've got some more. What should I do next?" And we're discussing different options. And just get this, guys, his passive income now, remember his goal was before about 6,500 a month. His passive income now is double that, 13,000 a month. But he moved the goalposts. He said, well, Chris, I really want more than that. I don't want to just be financially independent to pay my bills. I want some extra breathing room too. So I want 14,000 a month. Well, guess what? I said, hey, with 50 grand of your money, with one of the investments you're already doing, because it does, probably would return you roughly about 24% a year, give or take 23, 24% off that cash. You might consider moving it in something you're already investing in that's already making more money. And so I said, right there, 50,000 will make you an extra 1,000 or so a month. Boom, you've got your 14,000 a month goal. Guys, this was again in just a short period of what's that been? 6.5 years, right? 6.5 years. Granted, did he start with a lot of cash? Yes, of course. But we see this every day, right? Because here's the thing. What if I showed him the traditional thing? Let's just go to this screen right here. Okay, so let's just take this fact and let's take his current 401k and everything. So he had about $1 million in that. He was adding about 2,000 a month, so 24,000 a year he's saving. Now, if he got an 8% interest rate, now actually I'm going to bump that up. I'm going to make this 12%. I'm just going to go with 12% here because the truth is, the average has been about 12% since mid 2018. You should have made about really in the last little bit here, about 125%, give or take 120, 125%, depending on the day and when you're listening to this. It could be less because I know the market had a little rough February. So anyways, 12% a year, 7 years. So I'm even rounding up to this summer, right? And here you go. Now, does he have almost $2.5 million? Now I have inflation here at 4%. We know it was a lot worse than that. I'm going to put the average at about 7. I'm going to go conservative here. I know it's more than that. I know there's claiming it's less. We all know it's not, because even after that many years, how many of you guys have seen prices in the last 7 years go up more than 50%? Food alone, come on, it's sick. So anyways, buying power after inflation adjustment. And actually, you know what? Forget inflation. I'm not even going to include that. I'm going to leave that at 0 for right now because it's today's dollars. So it doesn't really matter, right? He's got 2.4 million, right? Almost, I'll even round up to 2.5 million that he might have had in his investment accounts. 2.5 million at 3% is 75,000 a year. What did I say he's going to be at here just in the next few months? That's right, 14,000 a month. You realize that's about 170,000 a year, 168,000 a year versus 75,000 a year. Now, for him to match that would take forever, right? Let's just say we go out 15 years. It's like, hey, well, I better not count 12% anymore. Let's put it back to 8, right? There we go, 3.875 million. Now, inflation obviously could be worse, but let's just say it's 3.5 million. We'll even make inflation nicer, although it'd probably be a lot worse. Even at 3.5 million times, that 3% would put you about 105,000 a year. Not bad. Obviously, not bad at all for where he's at. But I'll tell you, we're 7.5 going on 8. No, we're not even 6. We're not even 7 years in, right? We're 6.5 going on almost 7 years in. Give it another 8 years, guys. I would not be shocked if he would be well over 20,000 a month. He'd probably be much higher than that. But let's just say it's 20,000 a month. Let's just say that things slow down for him. What would you rather have? Would you have 20,000 a month at that time, or roughly about, in this case, 10,000 a month, right? Neither's bad, just so you know. And remember, part of this is based on, is the market going to return what we hope it returns? We don't know, right? The next 10 years, just so you know, Vanguard's predicting 2.8 to 4.8% return average per year for 10 years. That's nothing. That's nothing at all. So that's what I'm saying here, guys. Like, going from 100,000 a year to now to at least 20,000 a month. God, I mean, that's hardly anything compared to. That's the difference. If you do present planning right now, if you start focusing on the here and now, this is how it works. Now, let me peel back the curtain some more. I told you what he did, right? And you're going to be wondering, well, how do you do it? Here's the 5-step process we take people through. 1, we do that passive income launchpad. That's the first step, because what we're looking for is all the resources, like your financial plan. What are your goals? What is your timeline? Like, how soon do you want to do this? What do you want to hit? And we always do it based on income. What's the income you want to hit? Not the end number. What's the income that you want? Because that's ultimately what we all want, isn't it? We want to have income coming in to be able to pay for our bills, get us to be work optional, where we work because we want to, not because we have to. So we start doing that. We start looking for that low-hanging fruit. How do we free up cash flow and do this? I tell you all the time, like, we had one client that they are a business owner. One's a business owner, one spouse, a business owner. The other spouse works for a company, primarily a tech company, popular tech company, has lots of money in tech stocks. And that was the fear. And they were wanting to diversify out of it. But we were able to look at, we're like, listen, we can actually kind of do some things, refinance your house. We can actually free up almost 4,000 a month right there. About 3,800 a month we can free up by just refinancing the house, paying off certain loans. 3,800 a month. Guys, that's like 45 grand a year already without investing a dime. Then we save them more 30,000 a year in taxes year after year after year after year, right? And here's the cool thing too, is that we then said, oh, here's all the cash we can invest with. And that leads to our second phase. We did that low hanging fruit. We figured out what we can do. Then we started making introductions. They start doing stage two, which is often that first meeting too, which is explore. We start to explore and seek opportunities. And we have a vetted investment network of people that we have, grown over the years that we've learned to trust for ourselves that we also can connect our clients to. It doesn't mean we give them investment advice. We don't tell them they have to do it, but we say, great, here's some people that actually match your objectives. Because here's the problem out there today. Even if you happen to, one, you don't get people that work with you one-on-one with a coach that actually knows how to create passive income because they've done it, right? You usually work with somebody that's like usually a mastermind group or something like that, some community. And they talk about, here's some people we like and trust. But what you don't understand is off the back end, usually they're just getting compensated on the back end. So that's why they're recommending those people, not because they're good for you, not because it's going to match up with your goals. They're just doing that because they're getting paid on the back end. The problem is this, is that kind of creates a conflict of interest, in my opinion, right? Because you're getting paid, they're getting paid on that. How do you know they're actually going to be good for you? Not to mention if there's no real one-on-one attention, that personal, really side-by-side guidance, right? Where you're partnering together and walking together to say, hey, I don't care what you do. I just want to make sure you get the best results because I work for you. And you start to look at that and you say, oh my gosh, like, that deal, yeah, that's great. That's a great deal for some, but not for you. Because for your goals, you should be looking over here instead. Let's eliminate a bunch of these options. Here's a fewer options you can look at. Start going down this direction. It's up to you what you decide to do, but let's go down this path. You talk to these people. So you start to explore these opportunities. And that's when you actually start to make the deal. Once you start to explore it, you start to feel better. You can come back and talk to our coaches and say, hey, what do you think? This is some of my concerns. Here's, and whatever ways we can minimize risk. And then you can come back and talk to them about that. And then decide if you want to make the deal to where you start to make the income. Now, while you're doing that and start to build this income up and the income starting to roll in, you also start to protect your assets. That's the fourth stage. So one is that launch pad. Two is you start to explore opportunities. Three, you start to make the deal. Four, you start to protect your assets. Let's make sure we have the legal work in place. Let's have the tax savings in place too with a good CPA. Let's make sure we have the insurances and everything else in place. So again, no one event can take it all away. No car accident, no lawsuit or anything else can take all of your family's security away from you so that you can protect that. And then you do stage 5, which is, again, this is all cyclical, which is that income avalanche, right? Is you take that income and you invest it the next year. So you understand with that client, even let's just say that 900,000 made him 90 grand that year. Well, now he has 990,000 that if he earns 10%, makes him 99,000 a year. But guess what? That 99,000, by the way, he's also adding, his 2,000 a month or 20,000 a year or so, right? Actually, he has a little bit more. Now he's got over, really, he probably would have been 100,000 that year, that next year. He reinvests that 100,000 on top of the million. And then he throws another 20,000 on top. And now he's over 110,000 a year. And then you have that money, you throw it on top. And now that, 110,000 a year on top of the 1.1, you throw it together. Now you're making like 122,000 a year, give or take, right? And so on and so forth, right? That's how you compound and grow it, is that you're always reinvesting. And by the way, some of these assets grow independently of you getting paid maybe that 10%. That's why some of the rentals and stuff, like that's why it paid off well for him, because he had these rentals that made him good income and they appreciated, which then he would later sell off some of those rentals, take cash out. Now he's redeploying it, which is why he asked me, Chris, I'm at 13,000 a month. How do I get to 14,000? Hey, if you go do this other deal, you have this partnership deal you've already got over here, that 50,000 can actually generate about another 1,000 a month for you. And so it goes. And that's where it's fun. And you keep cycling through. You still kind of go through that launch pad, looking for low-hanging fruit. Make sure you're still keeping your cash flow in check. You, again, make sure that you're still exploring new opportunities. And then you make the deal as you have more cash. You're like, now I got cash. I got another 25, 50 grand. Now what? Put that in the next deal, right? And you do it again and again and again and again. As your estate grows and your assets grow, you want to protect it. Because again, you got to build a bigger moat to go around that bigger castle as it keeps growing and going, right? That is how you plan for the present and you create an even better future than those that do only future planning. That's why present planning is so important. Plus, let's be real here. We don't know how many days we have on this planet. I don't know if I'm going to be alive 5 years from now. I don't even know if I'm going to be alive 5 minutes from now. Better hope so, because this episode is going to end soon. But, we just don't know, right? The only thing that actually benefits our family today is doing this present planning. When you do future planning, I mean, that's good. But again, you may not be around for that future. No one will care about that future. How many of your kids would say, I would rather have you home with me now? Maybe your kids are just about to leave the nest. I know I'm at the point right now where I have a kid every year turning 18, right? Every year that's starting to turn 18, starting to look at leaving the home and doing stuff on their own, where they get to be too busy for me. Your time is limited too. Maybe you're in that same kind of situation. Maybe your kids are about to be teenagers. Maybe they are teenagers. Maybe they're already moving out of the house and you're starting to feel that pressure of, hey, once they get married, they're gonna have a family of their own. They're not gonna have time to be able to hang out and do what the things we want to do as a family. This might be my only time now. And your choice is either I just blow money now and just try to, keep spending the money, but then I feel guilty because, now I just spent the money I could have used to invest, or you invest it for today. You invest it to create that present plan, create that cash flow now that buys you the time and the freedom to be able to do those things. See what I mean here? What's it to you? You want to keep delaying and delaying forever because you were told you just got to lock it up in those 401ks and IRAs and pay off your house, and then eventually someday you'll be happy? Or could you actually create that freedom today and having more enough passive income to come in and pay off the house for you anyways? To have enough passive income coming in where you didn't have to wait till you're 60, 70, 80 years old to retire. That is the difference. So my challenge to you is this, is that if you're looking for a way out, if you don't want to keep slaving and saving for the rest of your freaking life, because that's what you've been told to do your entire life by stupid financial advisors. And again, I know they care about you to some level, but the thing is, they can't retire either. Why would you follow the blind to lead you to some blind place? You can do something better. That's what present planning does for you right now to create a much brighter future, much faster. That's why you can shave decades off of your financial goals by focusing on the here and now, creating that freedom today. If you want to figure out how to do that, go to moneyripples.com. There's plenty of information, plenty more free resources. And if you've got money, you're saying, what do I do with this? How do I get my money working harder for me so I have to keep slaving away for this money? Go to moneyripples.com. Try that passive income calculator today. Make it a great day, guys.